Hey, Mike, right here. It's Tuesday, January the 10th, and it's 12:15, which is a little later than we normally start. And I made a big goof up because I discovered earlier on that my reminder of when the program was going to start had not gone out. So I decided to hold the program up for a few minutes to allow me to send out an email just to let people know. And I apologize for this, but I will make extra sure that we get this on the books so that you'll get a chance to look at it later. And so please accept my apologies. And if we have somebody come on board, that'll be great. But the topic that I'm talking about today is extremely important. And I need to be sure that we understand what's going on with this program because what we're talking about today is business organization. And the reason business organization is so important is that we need to be able to see there are tax consequences, there are individual tax consequences. There are things that are really important about the way your business is organized. I have worked with clients in the past that have saved thousands of dollars in taxes, in the actual tax that they had to pay simply by changing the way they were organized. And we're going to talk about in a more formal session some of the things that you need to know about organizing your company and why it's so important. I've done this before. I've done this several times. I repeat it, but it's probably in the top 3 questions that I'm asked all the time. The second of those 3 questions is, what deductions can I take? And we'll make sure that that's the topic of a future weekly workshop. But today we're going to talk about organization. And if you get a chance to join me, great. If you don't get a chance to join me, what I'm going to talk about toward the end will be important. And I want you to understand that. But this is something that if you're working with your own business and you're getting ready to start it, if you can shortcut this process by utilizing the method of organization, the entity organization that I recommend from the start, it will really be a lot easier for you than if you're going to try and do it from the standpoint of doing it later on when you have to go and make a modification. So please be aware of what's going on here as we go through this process. I'm going to make a couple changes in the presentation appearance, and then I'm going to get started going through the process. So bear with me just a couple seconds while I change that out. I'm kind of excited. Zoom has apparently made some changes in the way they do things, because now I see that you can see what's going on. It even shows me what's being showed, and that's really important because in the past I've had problems with this where it would not do the things that I wanted it to do. So bear with me. We're talking about how your business should be organized. This is something that when most people go out to start a business, they will put something into Google that says something along the lines of, how do I start a business? And you're almost always going to be told that you start a business by filing with the Secretary of State and do some other things, and this is important. But even before you file, even before you get ready to ask for those numbers from the IRS and the state revenue departments, you need to know what your business should look like. And oftentimes, what I'm about to say is something you've already decided, and I'll talk in a little bit about how to fix that. But there are 3 choices. And you can be a sole owner, a sole proprietor. You can set up a partnership, or you can be a corporation. And that's what the choices are. When you first start a business, the minute you decide you start a business, you have created a business and you are the sole proprietor. It's the simplest way to set up a business. This is the main advantage of setting up your business this way. Because if you're a sole proprietor, then you have to keep in mind that all of the assets, the liabilities, the income, the profits, and the expenses are the responsibility of you as the sole proprietor and you alone. Look at that list. It's assets, that's the stuff you own. Liabilities, that's the stuff you owe. The income, that's the money that comes in. The profits are what you get to keep, and the expenses are what you have to spend to keep the business going. Another nice thing about being a sole proprietor is that losses in your business can offset other income. So when people are doing a business as a side hustle, what you find out is that they often have the chance to deal with an issue and bring in that money. And if they're also W-2 employees, then they find out later on that they can offset some of their W-2 income by that loss that they've had with the business. Now, I don't recommend that you purposefully create a loss. That's a more complicated task to do that and do that right. But if you do create a loss, which is usually what happens the first year that a business exists, then it works to your advantage, and you want to be sure to take full advantage of that. Profits are considered ordinary income, and that's very important because ordinary income is not capital gains income. It's also not it's not capital gains income. That's where I want to say it. Ordinary income is taxed at whatever your personal tax rate is. You know, we have a graduated tax system, which means that the more you make, the higher the tax rate is on the money that you make, but it's done in graduated segments. And so you only pay the highest tax rate on your most recent income. And once you get over a threshold, then you pay 10% on what's below that. What's above that, you pay the next highest rate, which I believe is 22%. Our purpose here is not to talk about tax brackets. It's just to make you understand that tax brackets exist. And ordinary income is taxed at this variety of rates that ranges from 0 if you make less than $24,000 or $27,000, $18,000, depends upon what your standard deduction is. If you have no income, you pay, or your income is below that, you pay 0 tax. If you have taxable income that's above that threshold, it starts out at being at 10%. And then I believe it goes up from there. This is different from capital gains income because capital gains income under current law is taxed in a graduated system, but there's only 3 levels. It's 0%, 10%, and 20%. But the income that you make, the profits you make as a sole proprietor are not subject to capital gains income. They're subject to ordinary income. And finally, the other thing you want to keep in mind is that self-employment tax is applied on all profits. Self-employment tax is the Social Security and Medicare tax that every employee pays so that they are funded in Medicare and Social Security. And the employee pays half of it. The employer pays the other half. And if you are self-employed, then you have to pay both halves. And that self-employment tax is 15.4% of all of your profits. It is 15.4% across the board on all of your profits. And that is in addition to whatever income tax you may owe on the ordinary income portion of that payment. There'll be more about this later, but I just wanted you to understand that this double layer of taxes is what a sole proprietor pays. Now, there's also an organization system called partnerships. And there are two types of partnerships. The first one is a general partnership. General partners share all liabilities and profits. The losses and profits pass through to the individuals for reporting on the individual tax returns, and the issues of liability and responsibility are the same as for the sole proprietor. So if you're a general partner and your business loses money, the portion of that loss that is attributable to you as a partner offsets your other income. But likewise, the profits that you make, the profits that are ascribed to you as a general partner, are subject, they're ordinary income just like the other, just like sole proprietor, and they're also subject to self-employment tax on that portion. Even though you're a partner, the portion of the partner's profits that come to you are considered the same as if you were self-employed. There's another kind of partnership called a limited partnership, and the responsibility for the loss or liability is limited to the investment made by the limited partner. Now, there still has to be at least one general partner in a limited partnership. In fact, I've done many of them where there may be several general partners and only one or two limited partners. Now, it's the partnership agreement, and this also applies to the general partnership, that determines how much money is distributed to the partners. The limited partner receives profits almost as though they were receiving a salary, if that limited partnership agreement provides for guaranteed payments. If the limited partner, if any partner gets guaranteed payments, they are treated just as if they were wages, ordinary income, so forth. So a limited partner who receives guaranteed payments has to treat them as though they were, they are their share of the partnership. It's just that the guaranteed payment says that this is what they will receive, and that's what they're taxed upon. Profits and losses for the general partners pass through according to the agreement, just like the general partnership. Now, here's the question. Here's the consequences of being a partnership. Are partners considered employees of a partnership, or are they considered self-employed? And the answer is, as I've just tried to explain, that the partners in a partnership, including certain members of a limited liability company, are considered to be self-employed, not employees, when performing services for the partnership. If you're a general partner of a partnership, or treated as a general partner in an LLC that carries on a trade or business, your net earnings from self-employment include your distributive share of the income or loss from that trade or business. General partners must also include guaranteed payments as net earnings from self-employment. If you're a limited partner of a partnership or treated as a limited partner in an LLC that carries on a trade or business, only guaranteed payments for services you rendered to or on behalf of the partnership are net earnings from self-employment. Limited partners don't pay self-employment tax on their distributive share of partnership income, but they do pay self-employment tax on guaranteed payments. I think I may have just said that backwards. So if you're a limited partner, what that's saying is that one of the things, if as a limited partner, you provide services to the corporation or on behalf of the corporation, then those are considered earnings and are subject to self-employment tax. But if your distributive share, in other words, the profit or loss that you receive as a partner, as a limited partner, that's considered investment income and is not subject to self-employment tax, but it is taxed as income. And it's taxed as investment income. So even though the same tax rate applies as to ordinary income, it's the kind of income that can make you subject to the current um, excise tax on investment income above a certain level. So a partnership is a much more complicated situation because it is truly a hybrid, and the hybrid condition is between what is passed over to the partner just as though they were a sole proprietor. Now, we talk about limited liability partnerships because I probably put these in the wrong order, because that's where the limited partner idea comes up. LLP is what's used for them. The IRS treats it as a pass-through entity with regard to income and loss. And some states treat the partnership as tax liable entity, but not Indiana. In other words, here's the deal. A partnership, whether it's a limited liability partnership or whether it's a regular partnership, is a pass-through entity, which means the income and losses are passed through. If you're a limited partner, whether it's a limited liability partnership or whether it's you're a partner in a regular partnership but a limited partner, then we've already talked about how that income passes through and how it would be treated, either subject to self-employment tax or not subject to self-employment tax. And if it sounds like I'm getting confused, it's easy to get confused, and I'm accustomed to dealing with these issues, but you can imagine how you, as a business owner, are going to feel trying to keep track of all of this stuff. What's taxed, what's not, how much is taxed, how much is not taxed, and so forth. And you may remember that I mentioned that one of the first things you do is ask how you start a business. And one of the things I'm certain that you would have been told somewhere along the line or would have seen in the Google listing is the phrase limited liability company, LLC. And people tend to jump to the LLC concept. Now, this is not an LLP, it's an LLC, a limited liability company. Why do we even have this discussion? Well, you'll remember that early on when we talked about sole proprietors, I said that all of the assets and liabilities of the company are the sole responsibility of the sole proprietor. In the case of a general partner and a general partnership, all the assets and liabilities of the company are distributed according to the partnership agreement among those general partners. The liabilities is the interesting issue, because what that means is that if the partnership or if the sole proprietor's business does something that is worthy of a lawsuit, or perhaps the legal term is a tort, or it could be fraud, or it could be something that a client is upset about because they think you've treated them wrong, all of your personal assets are available for that lawsuit to be used to satisfy. The assets are available there to satisfy the judgment in such a lawsuit, or to satisfy a judgment in case there's a tort liability. You can lose your personal assets because of the actions of your business. If you have employees as a business owner, their actions can be something that you're liable for and make your personal assets available for people to take. So the states have set up a business organization called a limited liability company. And under a limited liability company, the liabilities of the members of that company are limited to their involvement in the company, to their investment in the company, their equity in the company, and it protects their other personal assets that they've been able to draw out of the company and that are their own uniquely, to be protected from those kinds of lawsuits and so forth. So one of the most important things that we talk about with regard to a business entity is ways to preserve your personal assets within the confines, or so that your personal assets aren't taken. It's only the assets of the company that are exposed. But from a tax standpoint, from the standpoint of the IRS, the creation of a limited liability company does not create a similar protection for tax purposes. And for the IRS, a pass-through entity like a limited liability company is what they call a disregarded entity. And they look to the individual partners or the individual sole owner as the only one who's responsible for taxes. I'm not sure who's asking to get in. Oh, somebody's trying to log into the meeting and, oh, wait, here we go. It just came up on my screen. I apologize. I apologize to Stacy because she was there waiting to get in, and for some reason it wasn't showing up on my screen. So please accept my apology. I'm going through this whole long discussion about limited liability companies and the fact that under tax law, they do not protect the assets of the individual owners, whether they're partners or sole proprietors. And as I said just a minute ago, the IRS considers a limited liability company to be a disregarded entity. So there is a way to protect your assets as a sole proprietor, and that's what I'm getting ready to talk about right now. Well, a couple steps first, because you'll remember that I talked about the three kinds of business entities being sole proprietor, partnership, or corporation. Well, now we're going to talk about a corporation. And a corporation is owned by the shareholders. The income and losses are confined to the corporation itself. In other words, the corporation pays its own income taxes. Unless it's an S Corp, keep that in mind. The shareholders are also taxed on distributions. And because the IRS is always interested in collecting taxes, if you fail to distribute money to your shareholders in the form of dividends or other distributions, there can be consequences, particularly if it's a closely held corporation. Whoops, went too far. And there are no benefit limits apart from normal employee rules. And the reason that's important is this. Sometimes when we work with corporate entity or entity structure in order to define and guide tax activity, we'll set up part of the activities of the business in a C Corp so that the owners of the corporation can enjoy the same benefit distributions that ordinary employees do. If we have an S Corp structure, those that own more than 2% of the value of the corporation have limitations placed upon the benefits they can receive. So that's why that's an important thing to include here. So a corporation is a separate entity. The Supreme Court has ruled that a corporation is an entity in and of itself, apart from its shareholders whatsoever, and that's why it has to pay its own taxes and so forth. It is not a disregarded entity, and the IRS treats corporations as separate from its owners. So if you own 100 shares of General Motors, the IRS has no confusion with the fact that you and General Motors are two different entities, and that if General Motors loses money, that's General Motors' problem, that's not yours. So keep that in mind. Now, we've already mentioned the S Corp. Oh, well, I need to. When I set this up in the PowerPoint, I didn't get all of the stuff on here because normally I see both screens, and because of the way I'm set up today, I didn't do that. But let's talk about the consequences for this. As I just said, shareholders' losses are limited to the extent of their liabilities. Shareholder officers are treated just like any other employees. losses carry forward within the corporation to offset up to 80% of future income. And that's an important thing because the ability to offset income losses within the corporation changed slightly with the Tax Cuts and Jobs Act of 2017, and it changed again slightly again with, I believe they called it CARES 2, because prior to CARES 2, you were able to offset 100% of your losses in a going forward basis, but CARES 2 made that change to 80% of future income. You're always going to be on the hook for 20% of any losses that you want to carry forward. One of the other changes that was made during the COVID era was the issue of being able to carry back losses. And that was done so that previous income, you could carry back a loss to a previous year and then get that refund immediately. But the Tax Cuts and Jobs Act did away with that ability to carry things back, which is why the first CARES Act gave a limited capability of doing that. But we're out of that era now, and so we're in the era currently of all corporate losses are carried forward until they're used up, until 80% of them are used up. And then they're simply still losses. There's also a single tax bracket for a C Corp. That's 22%. I don't know that it's changed. I don't believe it's changed, but it's down from like 35%, which used to be the standard offset. The negative aspect here is that you get double taxation. The corporation is taxed on its profits as a corporation, and the distributions are taxed again when they are paid to the shareholders. And so while the corporation's taxes are the fixed 22%, for the shareholders, if they receive a distribution, that's investment income, and it's subject to the ordinary income taxation, but also to the excess investment tax, excise tax, which is, I want to say 3% on top of whatever the limitation level is. So that's actually a triple taxation because the money's taxed as ordinary income, and there's a 3% tax on the excess profits as well. The other negative to C Corporation is there's no qualified business deduction. We'll talk about that when we talk about S Corps. But the qualified business deduction is a deduction that helps offset income for pass-through entities. And that was also part of the 2017 Tax Cuts and Jobs Act because it was intended to offset some of the negative benefit that, look, if you're getting money from a C Corp and it's taxed at 22%, but as a pass-through entity, your tax rate that applies to you can go well over 22%. And so the qualified business income deduction intent was to help smooth out that difference between the potential of paying 28 to 30% on your personal income as a pass-through compared to only 22% for corporate income. If you're not with me, don't worry about it. What I want you to understand is there are reasons why you may or may not want to be considered a C Corp when you start your business. Well, let's talk about S Corps. And I apologize, I was putting this together and I didn't get all of my animations done. So now you're going to see everything all at once instead of one step after another. An S Corp, just like a C Corp, is owned by its shareholders. Because it's a corporation, it can be treated just as if it was a corporation, and the people who get their income from that are also going to be eligible to be employees. So the shareholders can also be employees. Frequently what I see when I work with a company is that I'll have a single shareholder. One person owns the whole business. Corporation rules are set by the states, and Indiana allows a single corporate officer and a single shareholder. From the IRS's federal tax standpoint, that's also quite fine. The income and losses pass through to those shareholders. So just like a sole proprietorship or a partnership, the income and losses pass through. There are benefit limits for shareholders with large holdings, as I mentioned earlier, and the definition of large is 2% or more. 2% or more is what qualifies you to be a large holder in an S corporation. So I'll give you some more details when we go on to a little bit later on, but that's the difference between an S corp and a C corp. Profits and losses carry through to the shareholders' personal taxes. Shareholder officers are treated just like all other employees, and that's important that you understand because the shareholder officer can be an employee. Now, based upon the structure that I'm going to describe a little bit more fully in a minute, this can reduce the self-employment tax of the owner of the business. And because it is a corporation, because it's a pass-through entity, an S corporation is also eligible for the qualified business income deduction. Now, the negatives are that you can only have 100 shareholders. My experience is that I've not had any experience with any S corps that have a large number of shareholders, but I understand the process and the reason why they would do this. Another negative is that the income tax on profits is not limited to a single tax bracket. And that's what I described earlier when I said it's going to be taxed based upon the individual taxpayers' tax brackets, which can go up as high as 35%. And there are benefit limits for shareholders who own more than 2% of the business. And this comes about, for example, health insurance benefits or health benefits are limited to more than 2% owners. They have to be treated as though they're sole proprietors. There are a variety of other things as far as limitations on your ability to put money aside in 401k, for your ability to get other kinds of benefits. This is not intended to be a benefit discussion. It's intended to be an entity discussion, but that's one of the limitations. And so sometimes if in a more complicated structure, you could have the deal where you set up a C corporation that operates is the operating company for the S corporation. And so that way the C corporation's employees can receive the full range of benefits, but the S corporation is the corporation where the money runs through. And so the profits for the corporation, in other words, the S corporation owns the shares of the C corporation and so forth. I'm not interested in putting together that kind of complicated situation for us to go over. Now, I've already talked about the limited liability company, single member LLCs or multi-member LLCs. Married couples may both be members of an LLC, although for tax purposes, if both husband and wife are members of an LLC, they don't get the same benefits if they were not members of the LLC. And keep this in mind, if you're setting up an LLC, don't make your spouse one of the members, because there are tax benefits to be treated as a joint venture, which is the other alternative that doesn't require special filing. My point, and I made it earlier on, is that frequently LLC status is chosen as an almost automatic first choice. And I'm going to try to describe to you just a little bit more information that you may find worthwhile in the way you set your company up and avoid the LLC trap. Because remember, I mentioned before that the IRS considers single member LLCs as a disregarded entity, and that makes them sole proprietors. Multi-member LLCs are treated as though they're partnerships. So the positives of this LLC structure is that the profits and losses carry through to members' personal taxes. They are eligible for qualified business income deduction, and they get personal asset protection for the members. The negatives are, just like with S Corps, the income tax on profits is not limited to a single tax bracket. We also have to give consideration to the issue of whether the partner is a limited partner, and you'll remember several slides back we talked about that. And then finally, as I mentioned before, spouses can be negatively affected if they're mentioned as members. So I'm trying to look ahead and see what's going to happen next. Now, this is what I want to talk about. This is the principal reason to bring this up, and that's for employment tax savings. Some of this is going to be a repeat of what I've talked about before, but here's the thing. Every employee pays half of employment taxes. The employer pays the other half. A sole proprietor pays 100% of employment taxes. Investment profits are not subject to employment taxes. Remember, I mentioned if you own shares in General Motors and you get a dividend, you do pay tax on that, but you don't pay employment taxes. You simply pay ordinary income taxes. Income tax is not the same as employment taxes, as I've discussed before. So all of these features can make it easier for you as the owner of an S Corp to save money. No, I didn't want to go there yet, so let's go back. Well, let's go ahead and leave that here. Here's how this gets structured. There are two ways to do it. We can either have your LLC treated as if it was an S Corp, in which case you get all of the benefits of being a corporation. You get to pay yourself a salary. You get to limit the amount that you pay in employment taxes to the amount that you pay yourself a salary. Any excess over and above that salary that you take is considered investment income and is only taxed as investment income. It saves the 15.5% self-employment tax on top of that. You also get the benefit of the qualified business income deduction because it applies over on your personal taxes as a pass-through. All of those things happen even if you simply have yourself treated as if you were a corporation. The downside of that, and that's what I was looking for, I thought I had a slide for that. The downside of that is that you are not a corporation. And so when you have issues of succession, when you have issues of partnership income or partnership distributions, the corporate laws do not apply. The laws in your state that apply to partnerships or sole proprietors apply to the transfer of ownership. They apply to the transfer upon death. Now, all of those things need to be addressed in various agreements, and that'll be a topic of next week's, or at least a future weekly workshop, because we need to make sure that you can do these things I'm talking about having you do. If you can set up your corporation, your business, as an S Corp from the get-go, from the beginning, then you don't have to go through the turmoil of switching over. Why do I mention turmoil? Well, it's like this. If you've set up an account and have a tax ID number in the name of your LLC, and you file to be treated as if you were a corporation, that's all you need to do is file. No new tax ID number is needed. If you want to actually be an S corporation, then you do have to apply for a new tax ID number. So what, you might say? Well, now that means that all of your bank accounts that you have had as an LLC, if you are simply treated as if you were a corporation, you don't need to change those bank accounts because you're using the same tax ID, you're using the same business name, everything else is the same. If you want to set up an actual corporation, then you have to change all of those things. And so you have to get new bank accounts, new credit cards. Think of all those automatic payments that you've already set up in your bank accounts. This can be a difficult switch. And if you are paid money by an entity that needs to have your W-9, needs for you to certify that you're what you are, now that you have to get a new tax ID number, you have to refile for all of those entities. I had a client that was paid by the government, and when she made this switch, I must confess, I didn't think about it, and neither did she. She was cut off from payment for almost 3 months until we got all of those things reestablished. So this is a serious consideration. I'm going to go ahead and stop the share now and come back to the screen. If you'll bear with me here. Why did that not stop? Okay. Apparently, we're all looking at Lance Patterson's name on the screen. If you're actually looking at me, that would be fine. That's certainly what we want to be looking at. I don't know why it stopped doing this. I'm going to go ahead and go back to the gallery where everybody's on here together. So, oh, you can see me when I'm in the other mode, because I like to save it when I'm in the, so Stacy, you can see me now. Okay. Excellent. I'll leave it like this. The reason I'm going to do that is when I publish the recording, it's easier if you just look at me, because, as good looking as I am, I want to be there. Anyway, I want to wrap this up because we're past the top of the hour, or will be shortly, and I don't want to take too much of your time. If you're going to simply be treated as if you're happy with being treated as if you were a corporation, then you don't need to take any further action. You simply file that form, and then you can start paying yourself a payroll. You pay yourself what the IRS calls a reasonable amount, and that's a flexible amount because it depends in part on how much money your company makes. It depends in part upon what a person that is doing the work that you do, the actual service you provide, what such a person would be comparable to in your industry. All of these things are considerations to be made for how much you pay yourself as salary. But presumably, the salary you take is less than the total profits that the business makes, and then you get to save that 15% against those profits that you're not paying self-employment tax for. As I said before, I've had clients, the one that comes to mind most quickly, we saved him $8,000 compared to what he had to pay for tax for 1 year to what he would have had to pay if we hadn't made that change. However, I don't know if you've ever thought about it, but if you want to pass your business on, sometimes that can be a complicated process, depending upon how you own it. Or if you want to bring on a partner, the changes in your organization with the state and your changes in the distribution of the profits or the losses of the business, if you're a partner, have to be recognized if you are simply acting as if you were a corporation. This is the big reason that being a corporation is a powerful tool, because now if you want to pass on the business, now if you want to bring somebody else in, it's as simple as sales of stock, or if the necessity is there in passing a resolution to create more stock. The ability to change the business, both for succession purposes and for protection purposes, is much more easily satisfied if you really are a corporation. But you have to decide personally what makes the most sense, because making a change, if you need to, is a complicated process. I'll make no bones about it. But if you're just getting your business started, then I would always recommend that you start out as a corporation, even if it's just you. Now, some people will recommend that you not make that change until your business gets bigger. But I see no reason to do that because of the complications involved when you want to make the change. So just start out that way. I have a lot of clients, some of you may see this recording later on, that I've worked with to get your business set up in such a way that you can take advantage of these organizational programs to make sure that what you're having done is what you want to have done. You know, there's another, one of the areas where this comes in most commonly has to do with those people that have real estate holdings. Because if you want to protect your real estate holdings, and if you are qualified to be treated as a trade or business in real estate, then you want to be sure that you're not paying self-employment tax on the profits from your real estate. And so the usual way to handle that is you set up a C Corp, you set up an S Corp, and then you let the S Corp be the sole member of the various LLCs that you set up to hold the title to the property. I don't want to get deeply involved in this, but there must be comments out here that I'm not seeing. Okay. Thank you all. I appreciate it. Hey, these kinds of complications are the things that you want to be aware of, but you may not want to get into the weeds for. That's what you got me for. So here's what we're going to do in the future. In order to make these things work, in order to make sure that they stand the test of time, there are some additional things that you need to do. And we're going to talk about them in the coming weeks. This month of January, as I mentioned earlier on, we're going to start using themes for the weekly workshop. And this month of January, it's going to be starting up your business. But more importantly than starting up your business as we go forward is to make sure that your business is complying with the things it needs to do to be a business. And so that's where we'll start off next week, is with the idea of what you need to do. One of the steps are why it's important and how you get it done. So stopping the organization piece that we've been talking about up until now, does anybody that's here with me today have any questions? Please feel free to unmute and speak up. Or if you don't have anything else to add, we can go ahead and get back with the rest of our day. And you can rejoin me next Tuesday when we will start at noon, not at 12:15, and we'll get things going. So any takers? Any comments? Very good. Well, then I wish you all a good afternoon, and I'm going to get some lunch. So take care.